to Random Gleanings. I am Chris. He is Jesse. Jesse, it's been a pretty good quarter for stocks.
Oh, man, unbelievable, really. Yep, and even going back a little bit further, this first chart here, which you found on the Twitter.
Bespoke. Yep.
Shows that we have hit the a kind of
100 days.
line in the sand, 100 days without
Yep.
a 2% pullback.
Yep. And you can look, going back to 1953, there have only been, 8 of them? Is that right?
This marks the 8th.
Yeah.
That's right.
Yeah.
Yep.
Next chart. Interestingly, Jason Gepfert from Sentiment Trader put out, you can see on this chart, the black circle that has a 0 around it. That's the 100-day mark. And then what happened after that over the next 6 months and 12 months, respectively. There was one negative 12-month period.
Yeah, I think we'll see the next chart will show a little bit of the evidence of the results of that. But to me, this is important because it shows that the path is, it's what a market does. It's got some bumps along the way, but
Right.
ultimately, both 6 months and 12 months out, the majority of the time, things are positive.
Yep,
So,
and circled down there in green. Mean is the average return, 7.5. After that, year after that, median is 7. Pretty good. And the upper end certainly was lower double digits. The bottom end was kind of around the 1% mark. But suffice to say, good, right?
Oh, very good. And so if you go to the next chart now, this now is showing 5 months of win streak, so not exclusively the 100 days without a 2% decline.
Right.
But those I guess 7 numbers are included within here. And
Yeah, and today is the 25th, so I think we've got 4 more trading days in the month.
That's right.
And so if the market finishes positive this month, which it would have to go down 4% to do that, then ultimately you're going to have 5 months in a row.
that's right. So we ought to join this club as well at the end of this month. And
there were time periods where you had upwards of 8, 9, 11
that's just it. And so again, combining these two kind of time periods of positivity, ultimately, it does not mean that just things have to turn over right here.
Right.
And
although I do find it interesting at the bottom of this chart, July 31st, 2023, that you had a 5-month win streak, and then you in the next 3 months had a 10% decline.
Yeah, for sure. Yeah, and those things do obviously exist, and so it's always a past is not a predictor of the future.
But still, to have a 70% win rate on a 3-month or a 68% win rate on a 3-month time period after that 5 months is pretty interesting.
Absolutely.
All right, next chart. Ryan Dietrich from Carson talks about some of the, we've talked about this before, defensives and what are they doing? Defensives relative to the S&P kind of rolling over. Consumer staples, that's sort of a downward trend on that chart. Utilities, kind of a downward trend on that chart. Real estate down. Healthcare fits in there too. Healthcare's been a little better, kind of middle of the pack. Mm-hmm. Not really down necessarily, but not
kind of flattish against
either.
the S&P, right? Yeah, and again, anytime that we're showing these relative charts, it's a little inside baseball, so I apologize. But ultimately, what he's saying is that these are kind of defensive sectors of the economy, and if they start to outperform the other sectors of the economy,
that's when
there's a little bit of a signal there, right? And he's saying definitively that is not occurring outright across these kind of 4 defensive sectors.
Right. It's not occurring now.
Right.
That's right.
That's right.
Which is a good sign. Okay. Next chart. All right. So this last week, the Fed met, and we got the dot plot for, updated, which they do quarterly, and this is March, end of the quarter. So you've had more people kind of get on board at the Fed with the notion of 2024 finishing with 3 rate cuts. Mm-hmm. Now, the big question is, why? Why do they still expect 3 rate cuts? Check out this next comment from Bob Elliott. The majority of Fed board members project that through the end of 2025, and of course that chart was 2024, so they're expecting more rate cuts in 2025. But through the end of 2025, Bob says growth remains above potential, unemployment remains at secular lows, core inflation remains above mandate for the 5th year in a row, and the Fed cuts 175 basis points or more. One of these is not like the others.
Yeah. And just for those in the audience, it's that last one that doesn't really.
Yeah.
I think what he's saying is that doesn't necessarily fit given all the economic strength that we're seeing, and so there is a question around that.
And there definitely is a question why it's being predictive. But again, Ryan Dietrich, pretty interesting. Next chart. He made a comment this morning. We found 20 times where the Fed cut rates when the S&P 500 was within 2% of an all-time high. Stocks were higher a year later 20 times. So, I will say, batting averages for what they are, the yield curve's been inverted now for, 18 months, basically.
19,
and the batting average since 1970 on a recession, when that happens, is 1,000. Just like this is saying 20 times when the Fed cut rates when we were within all-time highs, the batting average has been 1,000.
That's right. Yeah,
to the upside.
So nothing guarantees that,
Right.
as we've just discussed about the inverted yield curve. But I think going back to what Bob said about all these cuts being priced in despite the strong economy, it does feel strange. But I think what Ryan Dietrich says that gives me a little peace of mind is
it doesn't mean it's bad.
One cut, right? Especially one cut. Does not mean that we get to all 7 of those cuts by the end of 2025.
Right.
Number one, and then 2, it doesn't mean that it's bad. In fact, he says when we're at this strength in the markets, it at least historically has been okay.
Right.
So.
And here's a bigger chart of that, just so you can see it a little more clearly. The other thing about rate cuts that I'll say is that our friend Tom McClellan, who's the McClellan oscillator guy, he kind of got into it with Larry Summers the other day about where rates really should be, because Summers was asking, Summers served as served as U.S. Treasury Secretary under Clinton, I think, and then went on and was the president of Harvard and yada yada. But anyway, McClellan and Summers got into a bit on Twitter, and McClellan was pointing out that really the 2-year kind of tells you where rates ought to be, and it's 3 cuts lower than what it is right now.
Right.
So
Yep.
We'll
I
see
mean,
what happens
the
there.
pattern tracks. So so long as that doesn't reverse, then I think that's where I guess the market is pricing things at.
Yep.
So.
All right, what you watching right now?
So Angie and I probably dragged her into watching this that I'd heard about BlackBerry, about the BlackBerry phone that no longer exists. Research in Motion. It was good. I didn't recognize an actor outside of Carrie Ewells or what?
Right.
The guy from Princess Bride.
Okay.
But it was really, really exceptional.
Cool.
Yeah.
I'll have to check it out.
You should check it out.
We're watching The Recruit. We were kind of grasping at finding some things, still in Suits, but needed something. Suits just, man, it's 8 seasons. It's a lot. So we were trying to diversify out a bit. Found The Recruit. Man, it's awesome.
Yeah.
It's really good. And there's a season 2 coming out. So
Well,
check it out.
your Tigers have made it to the Sweet 16.
Sweet 16, baby. That's
So,
good.
yeah.
We didn't, I don't think with dropping 3 out of 4 of the last 4 games that we saw that happening. But it's good to see. It's good to see our guys playing hard.
Yep, absolutely. Well, friends, thank you so much for watching. We look forward to talking to you again next week. Watch for a special episode next week about direct indexing, something that you might want to pay attention to, especially if you've got dollars outside of an IRA. So check that out, and we'll talk to you again soon.